Hi folks, welcome to the Beginner's Guide to Accounting for Machinists and Manufacturing Entrepreneurs. This is meant to be a fun conversation that brings forward a lot of practical knowledge. It is not a substitute for formal accounting training if you would ever need it, but rather hopefully help you understand some of the buzzwords, some of the lingo, and how should you think about doing accounting in your own shop. We have a card here that's going to go into more details about how we run accounting at Saunders Machine Works, which is much more practical on a daily basis. Again, this is more of a fun thing to talk about. What is accounting? So most people think about accounting when it comes to profits and losses for their business and taxes. And that's a great place to start. When it comes to running our business, we do what's called an income statement. And that's one of the three key statements from an accounting standpoint. The other two are a balance sheet, and the third is a cash flow. We're going to talk mostly about income statement type stuff today. So when we sell a product or perform a service, we earn revenue. And we also have costs associated with that. They may be fixed costs like our rent and our insurance, which we have to pay every month regardless of what happens. And there may be variable costs like, say, raw material that we used in the performing the job, or let's say we sent out some parts to have a service done like anodizing and we paid for that and billed it to the customer. That's a type of variable cost. One of the key things to just know and understand the basics is accrual versus cash. Now, you should talk to your accountant about what you do. Here in the U.S., most small businesses actually have the choice to run either accrual accounting or cash accounting. What the heck is it? So it's actually pretty simple. Cash accounting means I earned the revenue when I got paid for it. Now, if you're thinking, well, could it possibly be different than that? The difference is that pesky thing like net 30 or net 60 or net 90. In other words, let's say on Christmas Day, I ship a product. And I ship it to that customer and I include an invoice, and they have the right to net 30 payment terms. So they don't have to pay me until January 25th, 30 days later. The question is, when, from an accounting standpoint, did I earn that money? And I mentioned this example around Christmas because in this case, we're bridging the year. For accrual accounting, you book the revenue when you finish the work. In other words, I submitted that invoice to the customer on December 25th. Whereas cash accounting, you wouldn't book the revenue until you got paid for it. In this case, perhaps as late as a month later. So that's a big deal because in the US, you generally pay taxes on a quarterly or annual basis. So it's a question of when did you earn that revenue? That's a verb in the accounting world, is when did I earn it? To get a tinge technical, what would happen in the accrual standpoint is on December 25th, you would issue an invoice. You would earn the revenue, but in accounting, everything has to be kept equal. But I don't have the cash in my hand that would have offset that revenue to keep things equal. So you create another asset called accounts receivable. So these things like cash and accounts receivable, those are on the balance statement. That's the second statement, which again, we're not going to talk too much about today. Now, here's the irony. Accounts receivable is considered an asset to an accountant, but the opposite of an asset is a liability. Liabilities are things like debt payments or loans or obligations that you have. While it is true that accounts receivable is an asset, most people rightfully think of it as a really bad thing because the reality is if I'm running my business and I have high accounts receivable, what that means in layman's terms is I'm doing work and I'm sending it to my customers and I'm billing my customers, but they're not paying me. I've got to wait to get paid, and that creates real problems. In fact, many small businesses fail, not necessarily because of a lack of profitability, but because of cash flow. Because I can't pay for my services, I can't pay my goods, I can't pay my rent, and I can't pay my employees with accounts receivable. There's a fun little thing called factoring, and there's other ways you could leverage or loan against your accounts receivable. But number one, I really discourage that. And number two, that's really more for advanced situations in bigger companies. But what it does tie into is another really important concept that I want people to understand, which is working capital. Now, working capital isn't really a super technical term when it comes to the accounting world, but what it means is how much money do I have to kind of play with in between receiving and paying for things? There have been some really successful companies in the past. One that comes to mind is Dell Computer, where what they figured out was, hey, let's make sure we get paid right away, and then we're going to take a little bit longer to pay our vendors. Now, as a business person, I don't endorse dragging it out. And I don't appreciate when our customers drag it out with us. I like to pay our bills quickly, and I like to be a good person when it comes to that. But in some cases, there's a more natural form of this. Most people have heard of Warren Buffett. Now, it's very difficult to summarize Warren Buffett or his success in any one sort of thing. But one of the things that Warren Buffett did was he took advantage of what's called float. Float is an insurance term which has to do with how much money the insurance company gets paid before they have to pay it out. Take, for example, homeowners insurance. You pay premiums every year, but the insurance companies actually know at a broad level when they're going to have to pay out obligations. They don't know when your specific home may have a problem, but they have enough homes in their market that they understand roughly what their annual obligations are going to be. So they have this working capital thing to play with. And so that's a really powerful concept. And that's one of the big important things I want you as an entrepreneur to understand is this concept of trying to pay attention to when money comes in and when money has to go out, because that is a really stressful thing. And it's not something that your accountant is always going to help you with, because a lot of times your accountant is someone who's going to come to help you at the end of the month or the end of the quarter or at the end of the year. So you want to have some basic skills to be able to make sure you can meet payroll, make sure you can buy the raw material, and just to make sure you have enough working capital. Many people will use, unfortunately, credit cards as a form of working capital. And again, I don't believe in debt. I really don't like debt, and credit cards are absolutely a form of debt, but it's worth noting that it is one tool that you can consider using. We'll wrap up here with some final comments on the income statement. And again, be sure to check out the other video where we're going to talk a lot more about how we handle accounting on a daily basis. Month-end reconciliations, our bank accounts, what software we use, and so forth over here at Saunders Machine Works. A lot of people talk about the term net income or profit or how much money did you make. And I don't care about net income, because net income is what I consider an incredibly dirty number. Its end result has almost nothing to do with how I think my company performed in a year. And one of the main reasons is that net income has a lot of non-cash expenses in it. So what is net income? It's gross revenue. So how much money did we bring in this year selling our products or selling our services? And then what were the expenses that came out of it? We take this Wikipedia example. We've got things like advertising and subcontractors and licenses and insurance and rent. Most of those look like they would be cash expenses. Cash expenses means I have to pay for them with cash. Now you're probably thinking, aren't all expenses cash? Well, no, they're not. Most of the expenses that you and I think of when it comes to a business, like rent or like utilities, are cash expenses. But net income also includes a lot of non-cash expenses. Now, you may not even see these because your accountant may handle them, but the two big ones are depreciation and amortization. Now, those two terms roughly mean the same thing. Let's take depreciation as an example. If I buy a brand new $100,000 machine, I actually can't count that as an expense, because expenses are meant to be things that are incurred throughout your operation of your business in 1 year. In the US, the government makes you depreciate that machine over a certain lifetime. And there are tables that deal with lifetimes of estimated use. It could be 2 or 3 years. It could be, for some buildings, 39 and a half years. We don't get to choose that number. So as a business owner, I don't like that, because if I spend $100,000 in 1 year, it would be really nice to take all of that expense and deduct it against my revenue for that year. But again, you can't really do that. Now, recently in the United States, we've had something called Section 179. Card here to a page where you can read more about that. Most accountants should know about that. In fact, if your accountant doesn't know about that, I would suggest finding a new accountant. But that lets you do what's called accelerated depreciation, or different things like bonus depreciation, where the government is trying to incentivize a business owner to make a capital investment. They're saying, hey, Joe, hey, John, I want you to go buy that machine this year. So we're going to let you take more of that depreciation up front, because what happens is more of that expense I can include in this year, the lower my net income is. And as a business owner, the lower my net income is, the less tax that I pay. And which is very inverted from what you might think. So I want to maximize my revenue. I want to maximize my profitability, but I want to minimize my net income, all done in a legal and ethical manner. Again, the point is I want to be incentivized to make capital investments, but I want to be able to make sure I'm rewarded for making that investment. So let's take a CNC machine, and let's say it costs $100,000. if you depreciate it across 5 years. Again, we don't get to make those numbers up. The IRS has very structured tables on equipment and machines and vehicles and buildings and so forth. That would mean each year for the next 5 years, I get to take $20,000 in my expenses against that machine. So in this case of this income statement, we would have an additional line of depreciation of $20,000, and our total expenses, instead of being $195,000, would be $195 plus 20, or $215,000, which means our net income would be approximately $80,000. That's something you need to be aware of. You should understand. It's really important to understanding really how much is a machine going to cost you. When should I buy a machine? It's one reason why you may have seen companies say, hey, buy this machine, qualify for Section 179. There's different companies that do and don't qualify for it. There's other quirks, like you have to take delivery of the machine. But one last thing, just so everybody understands, when you depreciate something, that's a good thing from an accounting standpoint because it helps reduce your net income. But if you later sell that machine, the sale is income. So let's say I bought this CNC machine for $100,000, and let's say I depreciated it $20,000 each year. But let's say in year 4, so I booked $20,000 per year for 4 years. So I only have what's called a cost basis of $20,000 left, because for 4 years I took an accounting depreciation of $20,000 per year. So that's $80,000 depreciated. So my quote unquote basis left in that machine is $20,000. Well, let's say it was time to sell that machine, and so I put it up for sale and I earned $55,000 from the sale of that machine. You are going to owe tax on that sale, and the rough calculation of that is going to be the $55,000 minus the $20,000 of basis. So from a very summary explanation, you're going to have $35,000 of revenue that you're actually going to be booking as a form of income, and you will end up paying tax on that. Just an important thing to note, that while depreciation is great, it does get what's called recaptured when you sell that machine, again, relative to what your basis was. So that wraps up our first video on the basics of accounting, to think about what's important. We've done a separate video on budgeting. For us, budgeting is a completely different thing. We don't even do it in the same Excel file as accounting. But these are really good things, whether you're an entrepreneur, whether you're running a machine shop, or whether you're younger and you're just starting to get started. Think about these things. Let us know what topics you'd like to see in the comments below, and we'll happy to build out more on everything from accounting to balance sheet stuff to cash flows to financial analysis and so forth. Thanks, folks. Take care. See you soon.